Let's see what's driving today's trade, and it is gaining with a gusto. From the markets desk, Julie Hyman, Dom Chu, and Adam Johnson live at the Chicago Board Options Exchange is Judd Pyle of Peak 6 Investments, who says that the S&P will bounce around the 1115 level this year and thinks there could be another 6% rally at any time. We're making up half of that right now. Also with us is Jason Pry, the Director of Investment Strategy at Glenmede, which manages about $18 billion. When Jason was with us last month, he said that stocks are not yet at the buying point for value investors. So, Jason, what about now? I mean, every time we have a big slide, right, a lot of people want to go in there and say this could be the bottom and pick things up. Was that a good idea yesterday at, say, 315?
So we're looking at it a little bit differently. We do think it's getting close to a buy opportunity across the board. What we have done is we have found some buying opportunities in specific areas. If you really dig into it, the domestic markets, large cap U.S. stocks are trading at about 13 times what we see as normal or trend estimates for earnings, which is pretty good. Not a great deal, but pretty good. But when you look into Europe, Europe's an interesting situation where you basically have the market trading at about 10 times normal earnings. Now, historically, that is a good buying point. If you look back to 2009, March 2009, the market bottomed at 9.6 times trendline earnings at that point in time, and that was an extremely good buying point for the S&P 500. We think that Europe may be one of those scenarios. We'd still protect against the euro, but Europe may be at a much better buying point. It's a little bit of a hold your nose and buy point, but it's a buying point nevertheless.
Judd, you agree? And you could bring the U.S. into this at this point as well. I mean, do you think Europe or the U.S. is a buying opportunity at this point?
Well, yeah, as I pointed out, I think that, Monday, we've got Alcoa earnings coming out after the close, and I think that earnings are going to be better than everybody anticipated, and that's just going to add fuel to Jason's fire. I think that 13 times that trend normalized earnings number, I would actually argue that I understand where Jason's coming from, but with long-term bond yields at 3% on a relative basis, those earnings start to look a lot better, particularly in the highly liquid mega cap stocks like a Microsoft, Intel, Oracle. You can get in and out of those stocks very easily if you change your mind.
All right, guys, hang on for a second. I know, Jason, you want to jump in here for a few seconds?
Sure. I was just going to state, if you came into this neutrally weighted as we are advocating at the beginning of the year, you're probably underweight equities now, and rebalancing back to a neutral weight, meaning buying equities up until that point, is probably the best approach at this point.
All right. We'll get back. I have been hammering that, we've seen gains, some strong gains here, but on lighter volume. That says what to you? That don't buy too much into this rally?
Well, I would actually buy something into this rally, but for other reasons. I think your point about the volume is absolutely well taken, but, we've reached a point where I think the market had gotten technically oversold by a lot of different measures. And last week, we really had a buyer's strike. There weren't people who wanted to dip their toe in the pool prior to the jobs number and all that. So last week on light volume, a rally like this, I really would have discounted it. But this week, I'm a little bit more convinced that this could actually be people saying, hey, we better buy before these earnings numbers start to come out. All
right, hard to discount, though, some headlines crossing right now. And this has to do with jobs and some consolidation of operations over at Wells Fargo. Apparently, they are closing 638 independent offices. What's key here is that it's going to result in them cutting about 3,800 jobs. So also looking for a charge of 2 cents a share. But again, I guess what's catching my attention here is the job cuts here. Jason, as long as we continue to see companies cut back on workers for whatever reasons, I mean, jobs are still a focal point here, and that's really problematic to the economy and really ultimately corporate earnings and kind of the whole market environment, if you will.
It really is. I think that jobs are going to be key to transitioning towards a sustainable economic recovery, or economic expansion. Right now, we're still in recovery mode to some degree or another. We have a little bit more of that window to go through. But at some point here, really the economy itself has to enter a self-feeding cycle that can go on longer. We need to have jobs gains as one of the main components of that, as it typically is in any economic expansion. As far as the market's concerned, I'm going to add my 2 cents in here in that one goal from Spain doesn't get us close enough, and it really needs to be a little bit more than more than that, Spain really needs to recapitalize their banking system following these stress tests, and that's going to be an important thing to watch going into the back half of July.
Carol actually interviewed the deputy finance minister, and he said he was optimistic.
He was pretty optimistic. He talked about consolidation among the smaller banks, which we're already seeing.
No, about the World Cup.
Oh, about the World Cup. Okay, I'm thinking about the financial system and the stress tests.
But he was optimistic about their World Cup chances as well, wasn't he?
He was optimistic about Spain's chances in the World Cup.
You know, interesting story crossing the Bloomberg terminal about pessimism peaking, because you had UBS cutting its forecast, and you had Barton Biggs coming out and saying he was selling. So two big bulls sort of capitulating here.
Right.
What do you think, Judd? Do you think pessimism has peaked here? I mean, is pretty much everybody turned bearish? Even the bulls are such cautious bulls that they might as well be cows.
Right. Well, Matt, let's go back and look at the end of April. We had kind of the opposite. Everybody was calling for a correction, and we went on for 2 or 3 weeks, kind of hitting new highs around 1,200 on the S&P 500. Sure enough, when everybody kind of got into the pool and gave up the ghost, whoop, right down we go. Now I think the opposite could be happening here without a doubt. When things get so bad and everybody does get that pessimistic, you wind up with kind of values, as Jason pointed out. Europe is getting silly, and you start to reach that area where we're going to go from fear to greed and greed to fear several times, which is why I'm saying we're going to bounce around unchanged on the year. We're just at the low end of that range right now, and people can, be kind of weeding through the wreckage to find some decent opportunities.
Now, Judd, it's Adam. You're talking sentiment, and I may very well agree with you, but I want to focus on something else you said, and that is specifically that earnings are going to be good. But why are they going to be good?
Well, first of all, on a comparable basis, we're still coming off of the second quarter of 2009, which obviously everybody knows was not one of our best quarters. So from a growth perspective, you just have the headline growth. The other reason why they're going to be good, and there's numerous, but when you're laying off as many people, all of a sudden, if you have an uptick in sales, it goes right to the bottom line. And State Street today was a great example of how when you have a little bit of a surprise on the earnings front, a positive pre-announcement, there's a lot of room to the upside because the market has priced in the worst. I don't want to see things through a rose-colored glasses, but I am trying to look at the value and say, hey, rationally, where do I want to take risk?
Jason, it's Dominic here. A lot of strategists out there are talking about this idea that interest rates are low, and they might go lower because why? The credit markets don't have any fear whatsoever of inflation or growth or anything else. What does that mean for corporate America, though, in terms of prices? If there really is no fear out there about anybody having inflation concerns, is there really any room for us to even go higher?
So I think this is a cyclical phenomenon for right now, and we're going to oscillate back and forth on this. Every time that the economy gets going a little bit better, we're going to see some increases in inflation. We're going to see rates rise. And every time we have another one of these debt scares, which are going to come across probably on a regular basis until we resolve this issue, 5 to 10 years out, we're going to have a deflationary scare, and we're going to oscillate back and forth between those. I think this is a situation where rates are going to remain low, but they're going to bump around based on these expectations of us coming out of the woods and then going right back in until we resolve these debt issues. It's going to take 5 to 10 years to really resolve these issues and put them behind us, and through that period, we've been basically saying this is going to be a more choppy sideways market. It's going to have an upward tilt because valuations are good, generally speaking, but it's going to be a choppy sideways market, and you're going to have to be willing to buy the dips, and you're going to have to be willing when things get more expensive to sell the highs when they come around.
What happens, though? I mean, how long until we see inflation, and how long do we see rates so low here, especially, on the long end, they're so low right now. Is that going to stay that way for a few years if you think it's going to take 5 to 10 years to sort out the debt situation?
Let's put it this way. Majority of these governments want to reduce their debt to GDP ratios somewhere between 20 and 30%. You stretch that, you can basically stretch that out over 5 to 10 years. It's going to create deflationary pressures, which they're going to offset with monetary easing. Until they're basically done with that, or at least in the back half of that monetary easing is probably not going to flow through the system in a significant form of inflation. Now, at the back half of that, there's going to be so much money in the system that when they're not reducing debt, it will be inflationary.
All right, guys, we got to run. Hey, listen, thank you so much. Judd Pyle of Peak 6 Investments, and, of course, Jason Pride of Glenmede. Guys, thanks for working us through the close, and, of course, our markets team right here in studio.